All right, so here we are with the direct write-off method example. This time we're dealing with India Company, but outside of that, everything looks strikingly familiar. I'm just changing up the method that we're using. So let's get into it. December 1st, India Company provided consulting services of $40,000 paid on account during the year, whatever the year is. So we will do 12/1. Our accounts receivable goes up, so we'll debit that for 40,000 because they're paying on account. And then service revenue will credit for 40,000. Nothing really changed there. Putting it into our folder like we had before. There's our AR folder. We'll put in 40,000. And then on our balance sheet, we will have 40,000 under AR. That doesn't change. Nothing's changed there. Okay, December 15th, they collected $15,000 cash from the transaction paid on account. Again, we will do December 15th. We will have cash coming in as a debit, 15,000, and then we will credit AR for 15,000 because we're getting rid of that accounts receivable. So we'll take it out of our folder, so 15,000 coming out, and we'll take it off of our balance sheet of 50 to 25,000. We'll take out 15,000. Okay, nothing's changed there. Now the next one. It says India Company estimates that $500 of accounts receivables to be uncollectible. But remember, we're doing the direct write-off method, so we have no I think period. So that would not even actually exist. I don't have to estimate anything. I'm going to wait until I know I'm not going to get it. So there is no I think period. So we can skip that. All right, now let's go into the next year. The next year is 3/1. It says after multiple attempts to contract customers, India Company determined that $240 will not be collected and elects to write off the account. This is the I know step, so we can go ahead and identify it as that. We're going to expense it here. Remember, last time what we did is we took it out of ADA, but ADA was already expensed. We don't have an ADA, which means we have nothing expensed yet. So we need to go ahead and expense it. So we're going to debit bad debt expense for the 240 and then take it out of accounts receivable. So we'll credit AR for 240. So in contrast, the allowance method, we took it out of ADA and AR. In this one, we're putting it into bad debt expense and then taking it out of AR because we had no ADA. There was nothing expense prior to. So on our folder, we're just going to take it directly out of the 25,000. So 240 coming out. That means our AR balance now is 24,760. All right. Now we go into 4/1, where we provide $60,000 of consulting services. So we will do accounts receivable debit of 60,000 and then do service revenue of 60,000. So we will add that 60,000 to our AR folder. That's going to give us 84,760. And again, on our balance sheet, it'll be 84,760. 430. India Company collects $25,000 cash. So we will do again 430. Cash would be debited for 25,000, and then we're going to credit accounts receivable for 25,000. These two, the 4/1 and 430, shouldn't be a big shock to you. We've been doing these from the beginning, really. We're going to take 25,000 out of the folder. That's going to leave us with 59,760, and again, that's what's going to be on our balance sheet. All right, then it says 5/2. India received $140 cash as a payment from the accounts previously written off. So this is our uh-oh. So we made a mistake. We prematurely wrote something off. So we need to put it back on to make sure it's correctly taken out of the trash, put back on our books. So in order to do that, we would flip the original transaction that we wrote it off as, which is the 3/1. So our debit would be AR for the 140, and then we would credit bad debt expense. We can't expense it because we didn't actually lose it. They actually did pay it, so we have to take it out of expense. And then now that it's back onto AR, we put it back into our envelope. We put it back into our balance sheet. This leaves us with 59.9. Now that we have everything back on the books, now we can take it off correctly because they paid for it in cash. So we would say cash would be our debit for 140, and then AR would be our credit for 140. So we'll take it off of the AR. So leave me with 59,760, and then on our balance sheet 59,760. So notice the whole time we did this, there was no allowance for doubtful account. There was no secondary envelope that I had to keep up with. It is I expense it the moment I knew I wasn't going to get it. So there is no I think. So that's the big difference between direct write-off method and the allowance method. So hopefully you were able to see that. Hopefully it made sense. But y'all have a good one.